Hi, everyone. This is Matt Lockaby. We're back with our second episode of the Employer's Playbook podcast. I'm the founder and managing partner of Lockaby PLLC in Lexington, Kentucky.
And I'm Grace Bandy. I'm the marketing coordinator here at Lockaby.
And with us today, our second guest, Logan Johnson. Logan, welcome.
Thanks. I feel very special that I wasn't number one, but was number two. I'll take it.
Number two is still pretty good.
Yeah. You still get a medal.
There we go.
Logan, kick us off. Tell us a little bit about your background.
Yeah. So I'll start from the beginning and work to where we're at now. My background, again, I'm a UK grad, Lexington local. Didn't go to high school here, but came down here for school. And then pursued a degree in mechanical engineering, which we can kind of talk about along the way, how that affects what I do today. And went to Toyota, major employer in Georgetown, started working in operations there, managing kind of day-to-day stuff, and then moved into a project management and basically vehicle launch role. From there was recruited away by a private equity firm located here in Lexington called Middle Ground Capital. Was founded by two out of the three founding partners were Toyota execs, and they love to steal people from Toyota. So that's kind of where I made the transition into finance, and we'll talk about that, I'm sure, more today, and where I fell in love with finance. After about 2.5, 3 years there, I had an itch, partly entrepreneurial, partly like philosophical, to move away from private equity, but still work in the finance space. And joined, partnered with a firm called Abri, where I'm at today. We do, really at the time, started just focused on financial planning for businesses and families, and we've kind of just expanded the firm to cover what we now say is we're a full-service financial consulting firm. We'll talk more about that again today as we go along, but we can do everything from personal financial planning, business management, accounting, bookkeeping, acquisitions, sell side, advisory as well. We've done a lot of corporate consulting around basically prep for sale, kind of, again, more like sell side advisory. But as we grow, we're just covering more and more of the financial space. And that's kind of where I'm at today. I spend probably 60% of my time managing individual businesses and families, and 40% of my time kind of operating the firm as well as growing into these new roles. And we're on the verge of kind of officially launching our brokerage, which is going to help business owners really go to market. At this point, that's kind of the one piece that we're missing on the business owner. Like, we can prep you completely all the way up to the day you're ready to ship the business. We just don't have a marketing arm for it to actually get you out to market. So we decided, hey, let's pursue that. And we're kind of right on the verge of getting that out into the marketplace. So excited about that.
Yeah, well, that's awesome. That's awesome. Congratulations, by the way.
Thanks.
I mean, our whole podcast is meant for entrepreneurs.
Yep.
And yeah, you fit the bill. This will be really fun. And so, but I want to go back first. Let's start when you leave Toyota and you go to the private equity firm.
Yep.
Tell us just briefly about your role with the company, what kinds of things you were doing on a day-to-day basis.
Yeah. Well, I think it's worth saying, anybody who's listening who is an entrepreneur or business owner or doesn't have a finance background, I have to tell people, probably my first day there, called my first week there, we were starting diligence on a company. I'll try to leave the lingo out. Diligence just means doing research on a company you're buying. Maybe everyone knows that's watching that, what that means. But one of my colleagues, she was really great. Her name's Jordan. Maybe she'll watch this. She was like, hey, I need you to basically bring some data together and put it on a spreadsheet for us. And essentially, a lot of times when you're getting information from a seller, they'll almost make it more difficult. They want you to fight for it, which is a topic we could spend probably 4 hours talking about, which is really funny. But they'll send it over in PDFs. And you're like, man, this is all going to go into Excel for us to build our model. Like, could you just send it in Excel? But sometimes they just won't, or they don't have it, or whatever. So sometimes you're doing the grunt work of just taking it out of PDFs and moving it into Excel. And I remember her saying, like, I need you to basically take like the labor line, like indirect labor, and move it over. And I didn't know at the time whether that was on the balance sheet or the P&L. Like, I knew so little about finance that I couldn't have told you like what ended up on a P&L or a balance sheet. And obviously in the course of like drinking from a fire hose, like in a month, I knew probably more than most people in the world knew about finance. But I think it'll get to a point, one of the questions Matt already prepped me for, or we talked about earlier, was kind of like, what's a misconception? It's actually much harder to be an operator, an entrepreneur, someone who runs a business, than it is to learn finance. So if you're afraid of the finance or something like that, you can learn. Yeah, so what did I do there? Our team really, there's two major branches in almost every private equity group. Middle Ground is a little different because their operational team is all in-house. A lot of times that gets sent out of house to consultant groups or whatever. I sat underneath the operational kind of hierarchy. What happens is a deal comes in from the investment team, and then they bring the operations team in to say, hey, first and foremost, like, is this a good company? So you're actually like sitting down with the executive team once a deal gets far enough along to say, like, are the executives there strong? I mean, is it actually a good business? Are employees all about to split and leave? Like, where are we really at with this business? As well as what are the improvements we can make? It was a very industrial focused, and having an industrial engineering background, we're actually walking the floor and saying, like, man, this machine does 500 parts an hour. I think it could do 1,000 if you just reoriented these two things or change this, or it does 500 parts an hour with 3 team members. I think we could do it with 2. And we're actually lining out all those things and then building a model that the investment team's job is to build the base case. Hey, nothing changes, runs a job. Our team's job is to say, what changes are we going to have to make, as well as how much does it cost, and then when will they kind of actually hit the P&L and flow through, so we could show, hey, our operational team can make all these changes over time. So that was the diligence side of it, going through really detailed operational things. And then post-close, my team's job was to operate that business. So typically in my role, my level is kind of like, I was the right hand or real parallel to the CFO. Usually there's someone just above me that was kind of like paired up with the CEO, but if they had any problems, any questions, reporting what was going on, any of those things that we outlined, hey, this has to happen post-close, it was our job to make sure they actually got done, and be along with them, as well as when we go to leave the company, typically kind of through a cycle is like you have the diligence, you have the first year. Our goal is to hit like all our KPIs for the first year. And then after that, it's kind of more maintenance. Like, hey, our whole team should be moving on to another acquisition, to be heavy work for about a year. You're maintaining that company. And then by year 3, you're, depending on the size and what you're doing, you're at least looking at either add-ons or distribution of that asset. So typically for Middle Ground's kind of portfolio, by year 3, you're looking at an add-on. Like, hey, let's find another company that's similar and bring them underneath. The nice thing about that point from the operational side is you've trained the executive staff so well that they kind of know what your expectation is, and they're really good about doing the projects themselves. So yeah, and then we get to distribution of asset. That mostly goes back to the investment team, where they're working with the investment banks specifically to get these marketed. We're talking about a couple $100 million, $1 billion purchase price tags. So these aren't like going through like a local broker. These are going through like big investment banks. You're getting 10, 20 bids to sell the business for you. The one thing we have there is basically cleaning up all the financials and showing all those operational impacts. Trying to think of like one of my favorite things that we did there was sometimes you would have an idea for an implementation where like, hey, we have 1,000 machines in this business. We improved 1 and it doubled its output, or we improved 100 and we doubled our output. We would actually put together a model that we would hand to the new sellers as kind of like a nugget to say like, hey, there's still 900 machines here that we already did this thing. Here's actually the technical drawings. When we'd give them like the engineering drawings and everything that was done to improve that machine. So they're like, oh man, if we do the thing that they did on the first 100, we're going to get to realize a 10% improvement in EBITDA, which they get to underwrite. It's just kind of like I don't know what you want to call it, a treat to try to get them to buy. So at sale, that was kind of our job, was do that stuff, as well as help train and coach the management team. Coaching a management team to transition ownership is an art in and of itself, which again could be a whole other podcast of just training them. And that we had whole teams of people that just came in to like record them and show them on video and teach them what to say and how to say it and present themselves well. But that was kind of our job to manage that as well.
Right.
So,
well, that's pretty cool. There's a lot to unpack, but I think the two things, no, but I think that's really helpful because when you talk about your role, like with a private equity firm as they were evaluating targets, right? Mm-hmm. And sure, there's this threshold, right? Can we possibly make this work, right? Mm-hmm. And some of that might just be gut instinct because you might not have all of the information you want, right? But looking at something that the seller's given you,
yep,
right, that there's enough there to move forward, right?
Yep.
But then you get to that second point, right? Whether it's right before or after you sign an LOI, mm-hmm. and you're really getting into the meat and potatoes of everything. So I want to bring it down though from like middle grounds, middle market presence, yep. right?
Yep.
And into like the kinds of folks that you're working with today at Abri, and we'll get to that here a little while, like more about Abri, but this entrepreneurship through acquisition, mm-hmm. right? So lower middle market, small, mid-sized businesses, EBITDA is almost always under $1 million,
yep.
right? And I'm curious, were there a couple of lessons, a couple of experiences you had at Middle Ground that you could easily apply to the small business owner today, right? And let's focus for a minute just on, say, that diligence process before LOI, mm-hmm. and then maybe the diligence process after LOI.
Yeah.
And just curious what your experience was kind of with that, in private equity, and how that can really translate to help small business owners or individuals who are thinking about, a first-time acquisition.
Yeah, that's a great question. Learnings from Middle Ground would be almost less of the technical, right? It's like more of the look for the core thing that the business does to make money, or the core person that the business uses to make money. So when I think about ETA or our current, I have a client right now that owns a business looking to acquire to grow, another thing that we run into a lot. And the interesting thing about we'll call it the low market, the smaller businesses under $1 million, is you're not going to get clean financials, right? There's just not a world where someone's going to spend $25,000 on a Q of E, and that'd be cheap almost compared to some of the dollar figures you talk about bigger businesses to get a full Q of E done. And even if they spent the money, the data is actually doesn't even exist except in a lot of the sellers' brains. So, and interestingly, it'd be easy to say that, like, okay, at Middle Ground, we always had perfect data and great Q of Es. That actually wasn't the case. What I learned more than anything from the, higher level people than me who had done acquisitions for a long time was there's really only two things that matter. One, do you understand the market that they operate in well enough to have a gut feeling about where it's moving? So this is like, for the client I'm thinking of right now that wants to buy to grow, they're in the commercial construction space. So looking in parallel markets so they can understand things they already use, plumbing services, electrical, things like that, to expand is something they actually have a market share understanding of. You're doing the same thing at huge companies, right? Do I understand the market we operate in enough to understand where it's going to go? Even big companies, like, well, we did a lot of automotive stuff. Are we going to do we believe automotive is going to continue to perform the way it has? Do we think it's going to change? And if it is, how do we operate there? So one, understand your market really well. That's pre-LOI. Like, you probably shouldn't waste someone's time with signing an LOI if you don't know what's actually happening in that market. And then two, understand the key players in that business itself. So as you'll see with ETA or, again, kind of acquisition to grow, typically these businesses are driven by one person. The dream, and the ones that get sold the fastest, you guys have probably seen this plenty, are the ones that the owner is not the one that drives the whole business, right? If you find any of those, like, I'll buy them tomorrow. It's like they've got a general manager who does all the work. It's like, it's a pretty easy valuation and you move on. And that's actually probably the bigger gap between these really big companies, right? It's like Middle Ground's buying from another private equity group. Sometimes buying from families, they buy across the board. But the whole executive team might have an ownership compensation, but they're not the owners of the business. So the next thing is understanding what do you kind of who is the key member, and if it is the current owner and their goal with the sale is to exit, then you need to understand what their main priority is. And if you can understand their main priority, if it's financial, then maybe you have to write a bigger check, which may not be interesting because, hey, we're trying to run this long term. If it's personnel, like, hey, I have 5 people who've been with me since I started this business, then you need to find a way to encourage them and help them see that, hey, I'm going to take care of your people. Maybe that's a better benefits package. Here's what my team has. It's better than yours. Your team's going to get better, compensation than what they have today through benefits and healthcare and things like that. But just understanding the key people and what their main goals are. Sometimes we identify the key person. We don't go deep enough to say, what's their main goal? It's like, well, Joe's the main person there. He does all the sales. All the sales flow through him. It's like, okay, great. What does Joe want? They're like, well, he just wants to sell and get out of there. It's like, no, Joe might just be really happy to go from being the owner and running the books and doing everything to getting a W-2. And again, I have a client who recently took on, basically, it wasn't an acquisition. It's actually the same person I was just talking about. They have they brought on a residential arm through basically buying a general contractor, but it wasn't actually a purchase price agreement. He basically just said, like, hey, why don't you just come work for me? I'll guarantee your salary. The guy was like, great, I'll take all my projects today, move them over to you, and kind of take that on. So understanding like what the goals are. Some people aren't looking to retire, but some people are actually tired of running their own business. So those kind of the two I think of.
Well, it's I think that's really interesting because you've got understand the market, right? Understand the business itself.
Yep.
And for a first-time buyer or first-time entrepreneur, they might see a business that they think is really sexy or has really good margins or whatever. But if they don't really understand the business, or if they don't really understand the market in which it operates, that can create some huge problems post-close, right? Then you have understanding key personnel, right? Or the people who are coming along with the business, which has nothing to do with the company's financial health.
Yep.
Right. Can these people sustain this business for me over after close? And then you have kind of, I guess the way I hear what you're saying intertwined in that is like sellers' motivations.
Yep.
Right. Do they really want to be out? Is this a clean break? Have they already bought the beach house and are they already like checked out, or is this more of a transition for them over the next few years? But okay, but one of the things that you said initially really did strike me, because a lot of our work is like first-time buyers and first-time sellers.
Yep.
And they're usually not, the sellers usually aren't ready for one of several reasons, but one of them is they're not ready because their books aren't ready. Mm-hmm. And they're not ready for the kind of scrutiny someone's going to give them and their books.
Yep.
And none of it is a personal attack. None of it is meant to be offensive, but there is this, I can't understand your books unless you keep giving me more information so that I can understand them. So but a place like Middle Ground has so many resources that becomes easy.
Yep.
So but also a Q of E, a quality of earnings report, isn't, I don't, in these lower middle market deals, I know everyone will say how essential they are, but the transaction costs are not worth it. And there's other things you can do, I think, that can replace the Q of E. But you're one of your clients is a first-time buyer, or maybe they're already an entrepreneur, but they're looking for their first add-on.
Yep.
Like, what's the process then for going through some really messy books to make sense of what you're trying to acquire?
I think, we ran into this recently. Actually, so I do kind of ETA on the side myself. So I'm in the process, should be closing in the next 2 weeks on my own. I think just understanding with that business. So again, I have to think about the advice on both sides, right? From the sell side, it's like, hey, if you can do the work and you'll put your thumb down to say like, I'm going to clean my books up. It doesn't have to be QV. You can be sitting down with a really good bookkeeper that you can sometimes find for $30 an hour. It doesn't have to be a dramatic expense if you're willing to put your own effort in. You can hand the work off to a QV team. They're going to spend you a lot because they're actually going through and they see some transaction. They're going to be searching that transaction, trying to figure out, oh yeah, that's actually for you bought McDonald's on Tuesday. It's like, or you can sit down with someone shoulder to shoulder and go through every transaction, which takes your time. So on the sell side, if you can do the work, it will help you sell your business. There's no question about it. Like, hey, I can clean everything up and make things really clean. Also, if your books are super clean, and even if the buyer is like, I have to have a Q of E, you're going to cut that cost in half, if not less, because I can introduce you to several Q of E teams. They're going to look at it and be like, man, this is basically a Q of E. You already did the work. It's all been cleaned up. So that's kind of on the sell side. Yes, I agree with you. And I think we both agree, like, if you really want to get this thing sold and you want the highest price possible, then go get your books like super cleaned up and organized really well. On the buyer side, let's say you're just working with an owner who's like, yes, I want to sell to you, but I'm almost avoiding the process just because of what you just said. I think that's kind of the scenario you're bringing up. One, I said this to someone the other day. It's people don't pay taxes on money they didn't make mostly. So tax returns are a really great starting point. If you actually look through a tax return, it's pretty weak on like financials. If you really think about it, they basically take like, it does show revenue that's booked, and it does show basically gross income or business income in some capacity, but everything in between is pretty weak. They have expenses, they have some expense chart, but again, generally, I won't say like 100%, people don't pay taxes on income they didn't make. So it's a really good starting point. So again, if I can get comfortable with a tax return as I'm looking at a business, or if I'm looking at a business for a client, that's a great starting point of like where we're at. The other thing is making a purchase price that allows for a wide enough range of swing in that number. So yes, someone, again, doesn't pay taxes on income they didn't earn. They might be off 10 or even 20% one way or the other, which is a bummer for them if they've been overpaying taxes and income's actually much lower because they just aren't doing accounting correctly or whatever else. But if you can make the purchase price at such that if income or profit of the business is 20% lower and we're basing it on that, and the deal still works for you, then you're in a pretty safe spot to move forward. I also think that if you want to be aggressive as an ETA or add-ons for your business in today's marketplace, if you can get comfortable with that, then you're going to be able to perform much more quickly. You're seeing this across real estate all the time right now, right? Mm-hmm. Every real estate investor today, especially over the last 5 years, all the people who bought in 2020 are crushing it because all their mortgages are sitting at 2.5% and doing great. As they're buying today, a lot more people are existing in this world of like, if I can make $1 a month of profit after I take all expenses into account, then I'll buy the property. Because their view is over 30 years, real estate always performs. And it can be the same thing in this in ETA of like, hey, if I can get comfortable, I'm going to take what they're showing me on their tax return, hope it's correct, adjust it down 25%, run my debt service if I'm going to take out loans, and then run like, hey, what do I need to make in order to make this worth it for me? You can likely feel pretty good about it without having to do a lot more of this financial due diligence. And on these small businesses, that alone can kill a deal. And if you're the first person to step up like, hey, I'm going to take the risk, one, you can get a better purchase price because the seller's like, this guy's ready to stick his neck out. And two, likely you're going to end up in the same kind of scenario either way.
Mm-hmm. No, I agree with that. And I think I think tax returns for us and for our clients have always been like a solid baseline, mm-hmm. right? We have to have this, mm-hmm. right? And especially if it's a stock purchase, we're getting the last 7+ years, yep. right, of tax returns. But it does give you a nice baseline of what you can expect, but they don't tell the whole picture, nope. right? And so when we see sellers who come to the table with the following, or when we have buyers who are requesting this, I mean, it's always, we still have to see your financials, right? Yep. We want your income statement, we want the balance sheet, but more specifically, you can use all of them. They're all puzzle pieces, yep. right? And you can just see how everything works together.
Yep.
But for these small businesses, what I think is really tricky too, and tell me what your experience has been with Abri, or even at Middle Ground. Every small business owner runs so much personal stuff, non-operational stuff through the business.
Yep.
Right? I do. It's just it's the nature of the beast. It's what ends up happening, yep. right? And so there is such a significant value though in the seller who understands that and is prepared to like show, all right, the add backs or the adjustments mm-hmm. of, hey, this is actually cash flow that you can immediately put back into the business. That makes sense?
Yep. I think that gets particularly, we get into this in a long-winded way if we're not careful, your goal of what your long-term hold is going to be. Because, we have people buying, like the client I mentioned earlier, wants to buy to add on. He will likely manage his business. He's young. He's in his 30s. He would love to manage for 30 more years. You might have someone else who's buying and their goal is growth in order to sell maybe up market to where you are selling to private equity and things like that. Well, private equity groups don't worry about running personal expenses through their P&L because there's not one person who owns it. It's a firm, and they get audited if they do weird stuff like that because the LPs are like, can't be hiding expenses on the businesses on our money that we let you borrow. So some of that becomes really important at that point. I agree. If you're representing a seller, and I mean, this is the financial engineering part that some people hate, some people love. You can read a million books about private equity, barbarians at the gate, the big ones. It's like, are we doing financial engineering? Or are we doing operational improvements? There's a mix of both. And actually at the lower end, financial engineering is almost easier to do because most parties are less sophisticated. When you're dealing with, Bank of America, investment bankers and Goldman Sachs investment bankers, they all can find every trick in the book, and they're doing hundreds of thousands of dollars worth of diligence. So hiding things at those levels, and again, the goal is not to hide, but to maybe like tell a different story, is going to be more difficult. At this market, it actually is, you're representing a seller, you can move things around and show, hey, all of this was personal, which is going to drive profitability up. And if we're trading on like a multiple, well, great. We're 2-3 times that dollar is actually what I'm going to get paid today because I pulled it out. Again, this is where you can get in a Q of E and you have a third party kind of make that decision. But if I'm a buyer, I'm trying to find as many of those things as possible. But again, it comes back to, if you want a perfect accounted for everything business, you're going to pay a premium for it. Because at some point, if it's that good, then it's on a platter and it's like, great, well, I could have paid 3 times the tax return, but we spent, $100,000 having all this diligence done. And now I'm actually going to pay 4 times because it's all cleaned up and it looks better than it was before. Mm-hmm. So I think there's an element of like, hey, the more you can take the risk and kind of take the swag and say, hey, I'm also going to you're running 100,000 to the business. I'm going to be the owner. I'm also going to run 100,000 to the business. So from an actual cash flow standpoint, I don't really care. Now we can talk about SBA and banks, and that's a different conversation where it's like, from a return standpoint, I don't care because I'm going to run just as much as you ran through the business. From a underwriting standpoint for a loan, then I want to push yours down as much as possible so that the bank knows, oh, there's all this extra cash flow. So that they'll sign a note so I can move on, which is kind of a separate topic. But again, in these deals, I think the more you can just get comfortable with the numbers at a high level and say like, this is plus or minus 25%, would I do the deal? It's like, yeah, I'd do the deal. Great. Then why are we going to go spend $100,000 to answer a question that just doesn't matter that much?
Answering dollars and dollars, right? Rather than accounting for something much larger.
Or slowing down the deal or scaring off the seller.
Totally.
Yeah.
Well, but I think you also raise a really interesting point, and this kind of dovetails back to something we started talking about at the beginning, which was, the focus at Middle Ground on just the operational improvement that it can make. Essentially, the value that it brings to the business, right?
Yep.
And so this is one of the misconceptions that I see a lot in first-time buyers who are looking for a profitable business. They're looking for something to get out of the corporate grind, right?
Yep.
They want to be their own boss, and they've figured buying first and then building is easier than starting from scratch, right? But it's a real differentiator for a buyer who comes to a seller and says, I really like your business. I understand the market. I understand what's happening here. And by the way, these are all the things that we think we can do over the next 12, 24, 36 months to take the business to the next level, right? And for an older seller who's getting out of their life's work, like there's something very attractive about what is in essence a strategic buyer saying, I can not only keep your legacy going, I can actually improve it, right? And so for those buyers though, I mean, they have to have a plan for what they're going to do. So are there are there things at Middle Ground that you all would look at? Like, what is, I mean, you're in manufacturing, so you're hiring Toyota people away from Toyota.
Yeah, very specific.
People who are like down to the second in the supply chain process, right? Like it's a science. But now we're looking at, I spoke to someone a couple months ago, first time buyer with a spouse, and they were looking at a couple of different retail businesses. Mm-hmm. And one of my first questions was, well, what's the plan? Like, do you just want a lifestyle business?
Yep.
Or do you have a plan for growth? Like what are they not doing that you're aware of that you can instantly do better in the first 90 days?
Yep.
And they didn't have
a great
an answer.
Yeah.
So, but you know, they wanted to be entrepreneurs. They wanted to be their own boss, and you know, but what is it that, like, at Middle Ground, just to have a fallback, right? For an example, like operationally, what were they looking at? How would they assess how much value they could bring to an acquisition?
Great
as soon as you closed.
Yeah, I mean, I'll break it into two pieces. You have the true, like, day-to-day operational stuff, and then you have it's not financial engineering. Financial engineering has, like, a negative connotation, but it kind of is. You'd be surprised how many businesses don't manage their balance sheet well. And this is probably the most technical concept for a non-finance person to learn is things like, you need to look up the terms like DIO, DSO, DPO, which are basically just measurables of, like, your sales, your incoming, your receivables, and then your inventory, just sitting things on that. With a big manufacturing business, that's huge. And then some obvious things, again, the way we break it up there is we have cash items and we have EBITDA items. So if you think the business is going to buy and sell itself, you know, to future buyers on EBITDA, so we're going to trade on that number. What happens on the cash in between is all spoils for the current owner. So first thing first, we always did an underwriting case of, could we return our investment in 1 year? What would it look like to have enough cash out of the business in 1 year? So things people don't realize is, hey, if you're sitting on receivables that either aren't being collected from a vendor or from a customer, you can go out and push to bring those in. And a lot of times, if they're backdated or, you know, out of date, past, some of these companies want to pay you, they just can't pay you the whole amount. So the day you buy it, you didn't really, I mean, yes, part of your purchase price is allocated to that, but you didn't really pay for that dollar. You paid 8 times the EBITDA or 6 times the EBITDA, whatever it was. So anything you can suddenly convert into cash on day one, either, again, we can get into loan dynamics, but effectively can be a dividend back to the owner. So that's a huge piece, especially like the clients you're talking to, maybe in like a retail space. That's one thing they just never understand. And in their terms, if you actually look at all of that from a cash flow dynamic, hey, we're actually having to extend $500,000 to go buy our inventory in the spring. And then I worked with a retail business recently, and it felt like they're just so cash poor. And then the money just pours in all summer because it was a boutique and, you know, they had a lot of things going through it. And it was like, guys, if we can start to go out to our vendors and say, hey, I want to buy $1 million worth of clothes from you all, but I don't want to pay you for 90 days, right? It's this terms thing, right? So that's the whole balance sheet work that we're doing, going through the terms that you're having to send money out and then pushing the terms of how quickly you get paid. For a retail business, for the most part, you're getting paid in 2 days. They're swiping your credit card, your point of sale software is holding it for a day, and then it's getting deposited in your account. So that's less of a problem. The big manufacturing businesses, we're selling to Ford. Ford is just as smart as we are, if not smarter. They have a lot of great finance people. They're like, hey, we don't want to pay them for 90 days, 180 days. Famous one that people don't know about, like AutoZone, the places you get those, a lot of them are 365 days from purchase. So you give them your product, it sits on their shelf. Me or you, we go buy a light bulb from AutoZone, the money hits their account, they pay you for it 365 days later. For non-finance people, you're like, okay, who cares? Like it's rolling forward. I still get the money. It's like, well, they get a year's worth of float. They never paid you for the product. So I get to hold, like anybody out there that wants to take this deal, I'll hold your money for the next year. I won't pay you anything for it, and I'll give it to you back a year from now. Well, you can do the whole opportunity cost calculation, all of that. So there's the whole balance sheet work, which I probably talked too much about and gotten too technical. If you have a balance sheet question, you can call me. But that's like a whole piece of it. Then you actually have the EBITDA items, which is actually like a larger impact. 'Cause you remember, if we're selling at 6 times or 8 times or whatever, Every dollar I generate in profitability, I get paid $6 for. Like, well, man, that's a pretty sweet deal. So if we buy the business at, big businesses at $100 million of EBITDA and add $10 million of EBITDA, I didn't just get $10 million every year, which does come back in the form of a dividend or whatever else. I also now, even if the selling multiple started at 6 and sells at 6, I now get another $60 million one day when I sell this business. So those things are going to be the things you think about. Hey, how do we get better contracts for our materials, right? It's really pretty basic. What do we bring in the door? How do I get a better price on it? When you get into manufacturing businesses, you get into like real technical material costs, like steel trades on a steel market, and understanding how those costs work. So you can get really technical, and you can have a whole team of people just working on that. But the big things we were looking at was like shop floor dynamics. Like Toyota's famous for Toyota Production System. Most of these manufacturing businesses throughout the U.S. have no clue what that really means. They might have like a Six Sigma black belt on their staff.
Lean Six Sigma.
Yeah.
Process
and they'll say the
yeah.
terms, but you'll get in there and you're like, man, no one has actually thought through the flow of this place. And then a huge thing that you see with these, I would say this happens in the market that we're talking about, that I work in today a lot, is just clarification of what the business is trying to provide. And there's something beautiful about entrepreneurs just saying like, I'm gonna do everything I can. I'm sure when you first started as an attorney, you're like, I'll do real estate, I'll do business agreements, I'll do operating, I'll do whatever I can get my hands on, because I just have to do work to like build my business, right? As you get further along, you refine and say like, I'm really good at this, I should focus my time on this. What you'll find with even 50-year-old small businesses is they never did that. They just are still like, it's like they're running a retail business that's supposed to be, I don't know, a women's boutique, which I've worked with in the past. That's why I use that example. And they still like always have this corner where they're selling like kids' toys. And you're like, why are you doing this?
Right.
Like no one's thinking to come here to buy kids' toys. Like they're like, well, we just like it. It's like, that's fine. If you're an entrepreneur, you have the freedom to say like, I like it. I don't care if it doesn't make me money. It's the beauty of being an entrepreneur. But that would be another thing. It's like, hey, let's just refine the product line. Again, at middle ground when we're buying businesses, there's elements where you look at it and you could actually do like part by part profitability. You're like, half the parts we make for Ford or GM or whatever don't make us money. So we have two options. We can call them and say like, you're getting a price change, which obviously is like, they're big dogs and they know how to negotiate those things. Or you can say like, we're just not going to make it anymore, which is, again, a huge risk, because you might make 50 parts for them. If you tell them you're not going to make 25 of them, there's a good chance the other 25 are going to go away as well. Which again goes all the way back to my very first point. Like you have to know the market really well. And again, talking about really big private equity groups, the founding partner there was the head of Toyota Europe division at one point. So it's not just that we're doing that negotiation. It's like he can call 4 levels up the person I'm negotiating with and say, we really want to make this work. So there is an element of like, know your market really well, and also have friends in your market because you kind of know what's happening. So.
That makes sense.
Yeah.
And what I'm just thinking about the luxury that provides.
Mm-hmm.
But okay, for these small business owners or for first time buyers though, I mean, there's one aspect of what you're talking about are process improvements, right?
Yep.
Like what is this business doing that you feel like you can streamline or make more efficient or improve in some measurable way? Because to your point on EBITDA, and even in these smaller businesses, right? Like that's what they're trading at. So if you're just going to get a 2x on a sale in 20 years, you're still
$2.
doubling the efforts that you're putting. You're getting double the amount out that you're putting in. But then I think what follows that though, I think that's like the first level that these ETA buyers are looking at. Like, there's it's, I don't want to say it's simple, but it's the most obvious thing, right? But when you get into contract terms, right? You're only going to improve contract terms if you understand like how the business really works, right? Mm-hmm. So what you're talking about, I think, when we talk about AutoZone and really having a really good handle on your balance sheet, is also just understanding the cash cycle of the business. And if you can find a way to have a positive cash flow cycle where you're getting paid before a service or product is actually attempted to be sold or offered, I mean, you've kind of won the game in a lot of respects, right? That's got to be a pretty crazy example to be able to hold product for a year and then pay someone 365 days later for something you already sold 11 months ago, right? But, I don't think you can really negotiate positive contract terms or improvements in the contract with a vendor or supplier or other business partner unless you truly know the business,
Yep.
right? Otherwise, what are you
Yeah.
trying to negotiate?
Yeah, and I think at some point you also have to, the tough part, probably on the contract side, that all of the clients that we're talking to today are going to run into is you're probably not big enough, depending on what you're buying and what you're producing and selling. Again, we could talk about a lot of different markets, to use your weight to make a change, right? I work with a client who owns a bridal shop, and it does not matter if she calls any of the wedding dress producers and says like, hey, I want to pay you on 60-day terms rather than 30 days. They're like, you can just not carry our product. Like, they really don't care. And they hold the whole industry kind of in that space. And so again, some of these things get taken off the table by just the fact that, hey, when you're only buying $500,000 of product from someone who makes, $50 million, they're like, they just don't matter enough.
Yeah, no, that makes sense.
That's a tough part on kind of that front, is just navigating those waters.
True. And that's something you may not, I take that back. It for a lot of buyers, it's something they're not going to learn until they're 90 days into the business. Mm-hmm. And they're thinking, oh man, I now have to invest even more money into the company beyond what I've just paid for it.
Yep.
Because I got to keep making this work, right?
Yep.
But we've also found, you having just a good relationship with the seller.
Yep.
Right? Like, it's not just getting on the phone and saying, hey, I'm interested, send me some financials and an NDA and let's get going. It's, there's value in breaking bread, having a meal, getting to know them, getting to know the business and their motivations, all of this stuff. It's the, I don't know, this human connection part that is so often lost. And it's like, oh, it's so essential.
Yeah.
Right.
Oh, it's huge. Yeah, it's huge.
I want to, man, there's so much here I want to talk about, but I also want to talk about Abri.
Okay. Great.
So you're at Middle Ground though for a couple of years.
Yep.
And actually I'm going to step back. We're going to go back to Middle Ground for just a minute, because there was this thing that you mentioned that I thought is just fascinating.
Okay.
Right. You're on the deal team pre-close.
Yep.
You're a part of diligence. You're evaluating, investigating the target. You close, and then you, from time to time, you would step into basically a leadership or a management role.
Yep.
But you were what? You were in your late 20s?
I left there in 2022. I was 29 was the late 20s.
But I this is just an interesting dynamic that
I'll add something to what you're about to say.
Okay.
Go ahead. But it's just,
But no, you're 29 years old. You're at a private equity firm, and you've just taken over, a manufacturing company.
Yep.
Right. And now you're someone's, or maybe hundreds of people's boss.
Yep.
And they're all twice your age. They've been working on the line. They probably know that business, or at least that part of the business, better than anybody else. Mm-hmm. I'm just fascinated by this. Like, what was that experience stepping into a leadership role?
Yeah.
Like, as a kid.
it was great. It was really fun. Two things, and again, this is specific to Middle Ground. I can give a generic, like a wider scope, but specific, like one great thing, the founder of Middle Ground, I don't think ever went to college. Maybe he ended up getting a degree along the way, but started like building cars on Toyota's line, ended up being the head of Toyota, the entire European division. So kind of having his resume as you walked in, of kind of being like, hey, my boss like started, especially with the people on the floor, started exactly where you're at. Sure, I went to engineering school, so I kind of got to like slide in like a little bit earlier, like a little bit higher than some people who start on the floor and build their whole career there. But Toyota also did a great job of that, like the whole team member first mentality of like, hey, we talked about it in all our Toyota meetings when I was a young engineer. Their opinion of what's happening today is far more important than your technical analysis of it, which I think is actually, probably a great general concept in finance or any job you have, in acquisition, any of it. So actually those relationships were really smooth for me, because again, part of my first job was just learning that, like, hey, sure, I have the some technical knowledge that's helpful, but I'm here to like provide you the tools and make sure the tools run the best way possible. Every so often I have to look at the job and how you do it, but for the most part, I'm going to take your knowledge of the job, apply it apply it to the tools and say, hey, this person always does it this way. Let's see why that's the best way to do it and make sure the whole team's working well. So the floor level was actually great. The executive level is actually much more difficult because one, I'm in my 20s, late 20s, we'll maybe say 30s if I want to gross myself up a little bit.
It's more interesting for my example if I'm
in my 20s, in my 20s. And so not only is it like, well, you're coming in, you purchase the whole business, so they understand that you're the owner, you're pretty deep in things, and you've come in with a list of sometimes they don't know all the changes you wanted to make. We have this huge, what we call value creation plan, VCP. It's like drilled into me, this acronym. Sometimes you're walking into the purchasing person. They're like the executive purchasing person's office. Guess what? They've done purchasing for tier 1 automotive suppliers for 35 years. I'm not 35 years old, So how am I supposed to navigate the waters of, one, it's my job to make sure these items get done. Two, there's a chance these were underwritten inappropriately because we didn't have all the data. Again, we're trying to move quickly through diligence, and I think Middle Ground kind of followed my philosophy of like, it's not going to be perfect. So like, let's get the deal done. Let's do the underwriting well, but understand we're going to make changes along the way. So how do I come in knowing like I have a target? It might not be a perfect target. You have 35 years of experience, and I'm like the age of your kids. I think it's in anything, it's being really humble and saying like, I am a really hard worker, and I deem myself to be a little bit of an intelligent person. So my main goal is only to like, similar to working with team members on the floor, is like, I'm technical. I'm your voice back to the ownership group and back to the boardroom. So if you help me help you, we can be really successful. So what tools do you need? What investment do you need? What am I not seeing? But also, again, the difference in my first deal versus my 20th deal there is understanding that there are people who are just stuck in inertia. You have 35 years of like, well, I've always worked with this, buyer at, XYZ group. This is just how we've always done it. And it's like, as soon as you hear that term, you're kind of like, there's an opportunity. This is how we've always done it. It's like, well, 35 years of doing it the same way. I have a feeling it could be different. So then it's, how do you get someone pushed along to at least ask the question of like, hey, this needs to change. How do we do it well? But it didn't always go super smoothly, but the benefit is like, I had bosses who were older than them and had more experience than them. And there were times when it was like, hey, this isn't getting done. And in general, I would say the goal at Middle Ground was to keep the whole executive team as much as possible. But there were times when people needed to be replaced. And that was probably the hardest part of my job. I wanted the person who I was kind of paired up with, like, hey, we have this huge purchasing initiative that needs to get done. Logan's going to be paired up with their head of purchasing, and we're going to get it done. I hated to finally get to the point of like, this person just doesn't want to do it. And that was the hard part. I just wanted to believe that, I'm willing to work my butt off for it. I believe it's possible, and they're just not willing to put the effort in, and they have to be replaced, which is the worst part about the job.
Right.
And probably the thing that I was glad wasn't like truly my responsibility, but it was still always hard to be like, this isn't getting done because this person isn't the right fit. And then they get let go. You're like, was that my fault? Like, I don't want you to go home. But the executive level is also easier to deal with that because most of them have great severance packages, and they're really smart people. And they're like, anyone I ever saw like go from the executive level had like another job 3 months later, and they had a 6-month, 12-month severance package. So it's like, well, they turned out okay.
Could have been worse.
Could have been worse. Yeah.
Well, but that's interesting too, though. Like just navigating the dynamics of change, really, that come with any acquisition. Right. And you certainly hear about that, the negative aspect of the change with private equity firms, right? Especially the ones who are really known for that quote unquote financial engineering and the negative connotation that it has. But how did you navigate that change? Right. Because I'm somewhat cynical in the sense that I don't think people change unless the idea of the change is worse. Or is worse than or is if the idea of not changing is worse than the actual change, right? So they're forced to.
Yep.
But yeah, I mean, tell me what that looked like for you. And I think in light of like the age gap, or maybe even the actual experience gap in terms of, boots on the ground with this person having all that experience in this particular role. Does that make sense?
Yeah. Rephrase the question for me.
Yeah, I'm just curious. How did you deal with it? Right, like the change has to occur.
Oh yeah.
These people are older, they're more experienced, they've been there longer, right? And you're kind of the fresh new face, but you're also really young.
Yep.
And there's those two things shouldn't always get like the dismissive treatment, but they do.
Yeah.
Right. And I'm just curious how you like navigated that from a personality perspective,
Yeah.
because like, and I don't want this to be like a 10-minute question, but there's so much legacy knowledge from these people who have been there for that long doing these things, and they're kind of key to the deal in a lot of respects, right?
Yeah.
So
yeah, I think personally, this was an attitude across the whole firm I worked at, but I think just something in my personality was like, well, if I can work harder and know more about the process itself, that will earn you a ton. If I know the numbers inside and out, then it's really hard for them to push back. So they say like, well, that's not how it works. Well, here's 4 examples of it working. So kind of coming back to the data of kind of like what that actually looks like. So personality for me, it was just like, I have to learn as much as possible and be as knowledgeable about how this works as humanly possible. The one thing I just cannot supplement really is the relationships they have. So if, again, we've always worked the buyer in this capacity, the only reference we really had and a benefit of being in one market and working on one type of business is, okay, I understand that's what you view this contract always is at, but we actually have another business that we currently own and they also buy from said same supplier, and they're at 90 days, terms, and you're at 60 days. So I know it's possible because that same business sells to somebody else at those terms. That's a really small, easy example. But that was part of it. And I think just really making them understand, and most of the executives there, from a compensation standpoint, were well compensated to be there and stay. A lot of these businesses that are being worked on have also been traded. So they're used to this change point. So you really get 2 types of personalities. One, they're excited for the change because maybe their previous owner gave a bunch of resources, got them to a certain level, and then sat on it for 3 or 4 years, paid down the debt, and then they were selling it. They're excited for another firm to come in and say, we're ready to take this thing to the next level, and that's exciting for them. And certain executives just thrived on that. Like, man, I've been waiting for extra investment in the company, and they're used to it. They're used to getting a new owner. It's really the ones who've maybe done that 3 or 4 times, and they're at the end of their career, and it might be better for them to move to a place that's like they're working for a Fortune 500 and they're just able to stay more consistent and have that. And that was kind of just a personality thing you had to navigate and figure out.
Right. No, that makes sense. Okay, so let's go to Abri.
Okay.
First of all, I really like Abri and the name, but I know because you've told me this, but tell everybody what it means and how you all came up with this.
Yeah, so Abri means shelter in French, which one of the best responses I ever got to that was like tax shelters, and I'm like, well, sort of, but no, that wasn't the goal. The goal was there's these communities called Abri communities. You can look them up, but it's kind of a place that people come and ask questions. And we kind of stole the name from them, and we just made it all about finance. So we wanted it to be like a shelter. One, we just think that across the financial space, everybody has a very strict opinion about one way to do things, and we just wanted to be a place to ask questions and then present all the ways to do something, which we get into the downside to that, which is only that, one, everyone who works at Abri has to be super knowledgeable, and you have to know a lot about a lot of different things. If you're only given a hammer and everything's a nail, that's actually pretty easy. I'm really good with this hammer. But the beauty of Abri is it's really just there to ask questions. Hey, I have a problem, and that's all we ask the people we work with to bring. I have a problem or a goal. That's really it. And we have every tool available to you in the garage, and we do everything across the board to help accomplish your goal. But just like if you're going to put, a new roof on your house, there's a million different types of roofs and how you install and all of that, rather than just say no, metal roofs are the best. It's I don't know if that's true. It's they might be the best for one person, but not the best for somebody else. So yeah, we made Abri to really just be that. It's like, hey, bring goals and questions, and we're going to go out and do the technical due diligence to figure out what the best thing is that aligns with not only the technical solution, but also like who you are as a person. If you tell me you want to be a millionaire next year, it's like, that's great. Are you want to work 100 hours a week for the next 50 weeks? You're like, no. Like, okay, well, that goal's not going to work out for you. You know, it's like there's ways to make that much money in a year, but it's not easy.
Right.
So.
Well, so as a business owner, then I'm curious because I find that when we hire, like I'm hiring for specific skills, right?
Yep.
Like we might need a lawyer or a marketing coordinator or a law clerk or whatever, right?
Yeah.
But that's what you're describing as something that I've really tried to do here, which is you're describing an ideal employee, though, who's curious and inquisitive and kind of well-rounded in a sense that they're not really a jack of all trades, but they're curious enough to learn as much as they need to really provide a holistic experience to a client. Does that make sense?
Totally.
I mean, how are you all vetting for that? You can vet for skills a little easier, but this is like a real personality trait. And how are you all navigating that, looking for each person you're hiring?
You know, I think the current kind of methodology, it's changed over time as we've hired more. You know, I was kind of the first hire. There's been 2 more since then, and then we're going to have 4 people start in September. So it's kind of our biggest class of people starting. It started with 1, and then it just like another great person showed up and another great person showed up. I think the main marker has been actually like the philosophical reason they want to do the job, of what are you actually hoping to accomplish by doing this? And I think the 2 answers that we really love are actually, one is going to be selfish, but first and foremost, like I actually like learning about these problems and helping people accomplish them. If that's not really why you're doing the job, which is like easier to say, but you know, you can tell when someone's being genuine. And the second part is like, hey, I actually want a career that lets my family have, you know, a certain lifestyle. Obviously in our job, it's like, as you get into different types of work, you can earn at whatever level you want, however many hours you want to work. But also you can build a schedule you want. You tell your clients like, we'll meet once a year. If your clients are comfortable with that and the service you deliver, then you can kind of do whatever you want beyond that, as long as you know you're accomplishing all the things you need to be accomplishing. So those are 2 things we really like in people. And then beyond that, as we've kind of grown, we've been able to supplement some of move the front end and the back end. For our first couple people who started with us, the goal was like, you kind of have to do all the technical yourself, all the personality yourself, meet with clients, meet people, do your own marketing. It was kind of like, man, you got to be a jack of all trades, really. As we've moved, we've realized that the real goal is like the people who are with the clients we care for, whatever capacity, whether it's businesses or or individuals or families or whatever, should really be focused on just what I said earlier, which is like get the best understanding of the goal they have or the problem they have. And if you can do that and understand like really who they want to be and what they want to accomplish, then we can supplement the technical by pulling that into systems and processes and bringing in people behind the scenes in order to really drive that forward. So yeah, I don't know if we've nailed it yet. You know, it's like we don't have 100 people and like we're humming along. The additional thing we've kind of done is every person who works for us picks a specialty after roughly a year. Kind of year 1, you're just kind of figuring out the business and where do you want to be. But you know, we have one of the advisors started with us last year. Her name's Morgan. She works just in the divorce space. So she went through divorce in her own life and just really like enjoyed helping people walk through that. Obviously that's a hard thing to go through, but she has a specialty in it and just wants people to understand like what actually happens to that. It's a really complicated financial thing. Most of us, and again, we're talking about ETA today, it's a really complicated financial thing too, but just like there's attorneys who specialize in divorce law, it's really specialized and it has a lot of complexity that goes into it. So that's the other thing that's kind of helped drive that, is to say like, hey, if we all have a specialty, then actually we can really hone in and learn everything about what happens during those things. So that's the other kind of thing we put in place. Like, hey, if you're going to be at Abri, yes, we have the ability to support all financial activities, but you need to specialize with the type of people you work with. One, because it's going to make you sharper on those technical details, and the metaphor I gave before of if we train you only how to use a hammer, everything's a nail. Well, we have a garage full of tools. What you'll realize is as you specialize, if your specialty is, I work with, I don't know, software engineers that work at Apple. It's a great market segment to work with. Their tax questions are simpler versus I work with only business owners, only real estate investors. Most of the conversations we have on the personal side is just tax related. It's like, yes, we talk about investment. Yes, we talk about, budgets and money and all of that, but most of it's investment back in the business. No, we're not talking about the market. We're not talking about retirement savings accounts, because if you've got a good asset like real estate or a business, that's where most of your money goes. So again, helping people specialize also builds that, hey, I feel really confident in this market segment, and just kind of drives that. Let's continue to be curious about how this is changing.
Yeah. But that also drives engagement on their end, right? Mm-hmm. Because they've had this wider exposure, right, in the first 12 months roughly.
Yep.
And they've seen, different aspects of the business or different problems that clients are facing. But then if they're given an opportunity to pursue what they are most passionate about,
yep,
it crushes engagement levels and, takes their client service to the next level,
Totally.
Okay. So you got into business owners just a little bit there at the end.
Yep.
And so I'm curious what, the business owners who are coming to you all, has it been long enough to see some themes coming through of what you're seeing, either the problems they're facing or the financial issues that they're trying to resolve with your help?
Yep.
To tell me what that looks like.
Yeah. Oh, I think it's, I'll go back to one we kind of talked about. The balance sheet thing, it doesn't matter, even owning your own business, is a huge weakness for all of our business owners. And I can touch on that in a multitude of ways, but the number of business owners that I work with, that if you look at their P&L or you look at their tax return at the end of the year, you'll see significant profitability, 7 figures for a lot of them, but for some reason they always feel poor. Well, why do I not have any money? Why do I feel like I still don't feel like I can send my kids to private school even though I really want to, or I can't take this vacation. It's well, it's because all the dollars that come in are buying your business for next year. Retail is a great example of that. Great, we made $1 million of profit. It's well, we need to write $1 million check to buy next year's things. It's great. So I made $0 this year. It's well, you actually paid taxes on that $1 million because it was income. And then you had to deploy all the money again. So that's a huge one. Is hey, how do we get this thing in a place where, one, you can actually feel like you're making money, and then across the board with that gets into conversations around lines of credit, understanding debt, terms, all of that. I think that's a common one. It's everybody's good with I bought a product for $100, I added a service and then I sold it for $500. It's okay, great, we got good margin. Anybody who can do that math is doing a great job. So the balance sheet thing is a huge problem. And then I think the bigger kind of philosophical question that we're dealing with all of them is, where do you want this thing to be? It's easy to, once a business gets to a certain level, to let the business run you instead of you run the business. And I just see more and more business owners that are kind of letting the business take the reins. The retail is such an easy example because, the next year you go to the same conference to do your buys, do your purchases for all the product you want to sell the next year. And all the same people you bought from last year are coming back to you hey, you spent, $50,000 with us last year, $100,000. We've got all these products, they're trying to sell to you, and you just do it again, plus 10%, whatever it is. Instead of saying, are we really being strategic with where our money is going and understanding, I spent $100,000 with them last year. We sold it all, but do we actually understand that this vendor made us 0 profit, but this one over here made us 80%? Clearly our customers want that product, not this product. So the strategic allocation of cash is the other thing, and really saying, am I running this business or is the business running me? And then just aligning with personal goals, which is kind of in the same vein. But I think some business owners need to be kind of grab them by the face and be hey, if we just leveled this thing out, just kind of kept it neutral, instead of taking the $1 million and redeploying it in the example I gave, there's a way for you to actually make $500,000 a year and your business just kind of like stay steady. It's like, do you want to like, I mean, you asked me like one of my favorite books. It's like Shoe Dog by Phil Knight. If you read Shoe Dog by Phil Knight, it's like he was broke till the day they went public. He had no money, like or very little, because every dollar had to go back in until he had the liquidity of the public market. He didn't actually have the ability to take very little money for himself. And I think that's the same thing for them. It's like, hey, do you want to just keep doing this and keep doing this? Or is it okay to say, you know what, like if I made $250,000 a year and I got to run my own business and I didn't have to worry about this like reinvestment cycle, then I'm actually really happy with my business. So just trying to align with like, what are you actually trying to accomplish? Or do you want to get this thing to $30 million of revenue and, you know, whatever in profitability and sell it? Like, where are we headed actually aligns with like what we're going to let the business do instead of just letting the business drag us from year to year. It's kind of like a big thing.
Yeah, no, that makes a lot of sense. But I mean, if I've spoken to one business owner, I've spoken to 1,000 who have said, man, we make a lot of money and our P&L looks great, but gosh, I never have any cash.
Yeah.
You know, I'm just, why don't I have cash?
Yep.
And then those same business owners, you're like, well, they don't have retained earnings.
Yep.
Like, so they're like one cash cycle or two cash cycles away from two concentrated or two key customers paying late, and now payroll's an issue. But if you look at their P&L, you'd never see the stress that's on their shoulders week to week.
And there's and the levers to pull to fix that are limited. Like, it's not like, I mean, I'm always very transparent. It's like, not like, oh, you work with Abri, I'll solve that problem for you tomorrow. It's like, well, you know, there's only certain things we can do. Terms that you get paid on, the margin that you sell your product for, and then lines of credit that are appropriately structured so that your cash stays in your account to at least create a buffer, or the line of credit is the buffer. Like, well, I'm going to pay my employees. I know that I'm going to get a check for $300,000 from this 2 weeks from now. I'm okay to write $100,000 on the line of credit and pay pretty minimal interest in order to pay that in the future. Some of it does come down to profitability, and that's the one thing people are like, well, we're making 40% margin. It's like, well, you actually need to make 60% margin because your balance sheet doesn't support the cash flow dynamics, and the only way to supplement is to make more money at some point. Like, if you can't fix the terms.
But it sounds like some of the business that you're providing, I mean, there's this consulting over, their finances and that extends to them personally.
Yep.
But there is this business coaching element to what you're doing for sure.
Yeah. And that's always been the funniest part about me being at Abri was like, is this a business consulting or is this a personal like consulting relationship? Like, what are we doing here? And I think that's been like my favorite thing to wrestle with. At times it's been like, I just want to stop any personal. Matt, I don't care about your budget at home. It's not like I'm just going to make your business as profitable as possible. And, I have to remember that that doesn't actually accomplish many goals, because some of the answer could be like, I mean, I don't work with Matt, but if I did, it'd be like, well, you should just work 100 hours a week and you can take on all these clients and you can push your billable hours up by $100 an hour or $200, whatever it is. Like, look how much more money you'd make. You're like, yeah, but I'd like to like see my kid's soccer game, And I'm like, but if I'm just a business consultant, like, I don't care about your kid's soccer game. So I've really enjoyed, which I said at the beginning, like, why did I leave middle ground? It was like entrepreneurial and philosophical. Like, middle ground, they take institutional money, and invest it on behalf of them, and their goal is to get the best return possible. So like, when I'm sitting down with an executive team, like, here's our strategic outlay. If that means everyone in the room works 100 hours, well, I was too, so I didn't feel bad about it. But it wasn't about like whose soccer game we got to or anything like that.
Right.
It was about returns, and I think for me that didn't align with like who I am. And again, I have some clients who come in like, I don't want to talk about personal stuff at all. I just want a business consulting. Like, that's great, and I'm happy to turn that engine on from time to time. But as a person, it doesn't align with like who I am and kind of normal goals.
Yeah, no, that makes sense. Well, but you can apply that to any professional services business, right?
Mm-hmm.
Well, if you just build 2,000 hours a year, I mean, imagine how much you would make.
Yeah.
Right? Consider 98% realization rate. Look how much more you'd make.
It'd be great
if you just worked all day.
Yeah.
So, okay, which is not the point of like what most entrepreneurs or people in the ETA process are looking for.
In the market that we're dealing with. Yeah.
Absolutely. Okay. Well, what is, are there any lessons you can pass on or tips you can pass on to the business owners who would be watching this to say, all right, you want to improve, you want to improve the business in like one or two ways to get yourself ready for sale, right? They're aging. Maybe they don't have an exit strategy or a retirement plan, or they can't have a retirement plan because there goes the business, right?
Yeah.
What are there, like, just give us 2 or 3 things, like most important things they can be looking at for the next 1 to 2 years to get themselves in as good of a position as possible for sale.
Yeah. And first and foremost, if you can move your role to somebody else who either holds a minority equity position or no equity and maybe has some bonus, that's huge, right? If you have the cash flow to support even bringing in like a general manager or whatever it is, that you can actually let them know that the goal is 2 to 3 years from now for them to move to a new owner and actually work alongside them, incentivize them in that way. Just letting them know from the front, hey, I'm hiring you to take over my role. I will be here as much as you need me to support your transition. But the goal is at some point for me to very much look like a passive owner and for this business to sell to someone else and you to get a new boss. There are personalities out there that would be super open to what that would look like, but finding them is hard. You know, just got to find the right person, and it's a sensitive conversation.
But so
one is
decreasing owner dependence.
Yep,
right.
Decreasing owner dependence.
The business has to run without the owner.
Yep.
First one in and last one out every day. Right?
Yep.
Okay.
Yeah. Trying to think if I'm trying to, but every business is different. So I feels like, okay, for one business, like a key thing, I think removing any contractual liabilities as much as possible and cleaning that up. To just say, I don't want to, if I'm only going to be here for 2 years, I want to make sure there's nothing in my business or on my books that a new owner would have to be committed to. So that can be a purchase contract that you say like, well, we locked in prices for the next 5 years. It's like, well, as a buyer, that's very intimidating for me. It could be a good thing. You could think like, hey, I'm going to, this is going to solve a problem in the future. But you go through cycles where steel prices drop, during COVID, and suddenly what you thought was a good thing, steel prices are on the rise, or, are cycling, actually turns into a really bad thing. I said that backwards, actually. Steel prices went up during COVID. But locking yourself into any long-term liabilities, so starting to think a little more short-term for anything that could be rendered bad. Go ahead.
Let me ask you about that.
Yeah.
Because I think of like OpEx and CapEx, and some of those items are, 1, absolutely necessary, or 2, just from a strategic perspective, generally like, your capital expenditures that are for the long-term health of the business, just you got to do.
Yep.
Right. So, but outside of those things, right, what you're saying is just be really wary of where you're spending money and, the term that you're committing that cash to, right?
Yeah. Yeah. And I think, which kind of what you just said, the CapEx question is probably my third one, is if you can identify as many of the changes that maybe you haven't done. You ran the business and grew it aggressively for 15 years, and you've kind of been in a 10-year, like, I pay my bills, my family's happy, I enjoy doing it. I'm either aging or getting tired of running this business and ready for it to move on. But I've known there's these 10 opportunities. If you can take the time, being the expert in the market, and start to flesh those out, that should only drive a higher purchase price for you. So I guess 2 to 3, I don't know, I could give a long answer. But I think 1, getting it out of your hands, and then 2, probably my number 2 is like identify opportunities for the buyer. Again, there's some buyers who might be really comfortable with like, hey, if this just is exactly the same way for the next 30 years, I'll just buy it and sit on it and just kind of run it day to day. But I think most buyers are, even if they're not planning to do those things, they want the risk reduction that provides. Hey, if there's $5 million more of revenue that I could add, well, if the $5 million revenue that you currently have goes away, then hey, I've got an opportunity to replace that revenue over the next 2-3 years if I take over.
Well, for most buyers, they have to do that, right? Because they're taking on a loan that the current business may not have.
Yeah.
And if it's an SBA loan, they have a personal guarantee. So yeah, they have to find that value, right?
Yep.
But what you point to though is a staple on like the questions that we give to first-time buyers to ask of sellers, and one of them is essentially, hey, if you were going to be there for 10 more years and what's the one thing that you're going to do in the next 24 months to, I don't know, expand the business, enter a new market, whatever it may be.
Yep.
And the business owners who have a really good answer for that they're kind of worth their weight in gold. They're like, okay, this person knows the business, they know the market, they know where they want to go. It's just, they're 70 and they don't want to now.
Yeah,
but they, those are the people you treat with like a white glove service.
Yeah. And the third, maybe my third thing I will add is, this is obvious. As a seller, like, don't wait too long to start the conversation, whether that's with someone like Matt or someone like our firm. Like, just start the conversation with someone. Maybe going directly to a broker can be intimidating, because sometimes a broker's main goal is just like to get you listed, get you sold. But having a conversation with someone who's worked with businesses across the board, just really understand where you're at and kind of give you your options and lay them out. The worst thing you can do for both yourself and your business is wait too long, because one, you just get to the point where you're tired. I mean, running a business is exhausting. Even a good one is a lot of demand. It's easier whenever maybe you've owned it for 20 years, you have no debt on the business, and you're like, it kind of makes money. Even if it could make double, but it makes enough to pay my bills, it's a little easier to sit on it because, worst case, it evaporates. But almost every business owner I talk to, the thought of it evaporating doesn't even necessarily hurt them. Obviously selling it would make them more. They're not really worried about it by that point usually, but they care about their employees. A lot of their employees started with them when they started the business. Like, man, I've had these, people for 20 years. The thought of it evaporating is really going to hurt them because they're still in their 50s and they were planning on being with you till they retired in 15 years, but you're thinking about exiting because you're in your 70s. So if you wait too long, you'll get exhausted. Or you'll just stop reinvesting so much to the point where the business will shutter itself. At some point, businesses just stop operating themselves. If you don't give it some cash, and whether that's CapEx for, actual projects or marketing costs or whatever that thing is, it pushes it forward. So don't wait too long, but just approach the right partner. I think attorneys can be really great for that because they typically, they don't have any incentive for you to sell. Really, like, there's like very, very difficult to make an argument. Even my firm, it's like, I'm always gonna have some incentive for you to sell, whether that's like we're managing your money afterwards. Like, I'm not gonna try to hide from it, or we sell the business for you and we get some fee for that. It's like, we will always be really transparent, and we are, I would say, I do fine. I don't like need your money to make it to tomorrow. But I just think waiting too long, I see as a huge impact, just because you're afraid of like the answer that might be there. And maybe you sit down with Matt and you go through it and you're like, I don't feel like doing any of this. I'm just going to wait for it to close. You're like, great. At least you have an answer of what you're going to do, rather than wait till like, I need to sell this next month. And you come to me or Matt and we're both going to be like, you can either give it away for like like pennies on the dollar, or you can close it because a 30-day closing is just not going to happen. So just don't wait too long.
That's just the problem, right?
Yeah.
If you don't have any options, you have no leverage, you're just going to leave a lot of money on the table.
Yep.
But I do have some incentive as an attorney. One, I just love a good deal. So
yeah,
let's do it. All right. Well, this has been really fun.
Yeah,
I've really enjoyed this conversation, and we've kind of weaved our way in and around, but kind of like just had this really good conversation for, I think, first-time buyers and sellers to take a lot away from. Are you ready for what I enjoy the most out of these, though?
I love it.
This is a lightning round. So I'm going to ping you with a couple of quick questions, and whatever comes to your mind, just hit us with it. Okay. So what book do you think every business owner has to read?
Yeah. I wanted to give like a unique answer. The two that come to mind immediately are like Traction, which is like just a great book about, I don't know if you guys talked about it on here before, but it's a easy, like, hey, how to operate a business. Like, it has great, practically, if you've never been a CEO or like run a business, how to actually operate a business. Buy Then Build is great for the ETA community. Anyone who's in the community has already read it, to be frank, but if you're just your first thought of like, hey, if I'm going to buy something, what does it look like? Especially if you have no market knowledge, like we talked about before, it'll help you refine the process of what am I looking for? Like, why am I looking for it? What's my purchase price? What's my role? It'll actually help you build kind of your vision statement. So if you go to a broker or search fund or whatever it is, you actually know what you're looking for. Even if you just want to scroll on the deal sites yourself, you'll find it's overwhelming. There's a lot of really bad deals on there. But if you at least know what you're looking for, it gives you a great starting point. Personally, I already touched on it. Shoe Dog by Phil Knight is a story of Nike. Again, which feels a little, I was nervous to say it as I thought about it. Feels a little ridiculous because I'll be frank. I doubt if anybody watching this podcast or me or Matt ever going to build a business like Nike. I could be wrong. I'm only 32, so who knows? Maybe I'll have the next Nike. That's not my goal or my lifestyle choices. Those jobs are really hard, but I just think that it does such a good job of the whole scope of entrepreneurship. One, like the accidental entrepreneurship, he had an idea and created something. A lot of what we're talking about is like buying something. Again, I'm not an idea person. I'm a great refinement person, a great improvement person, but I I'm going to create this brand new business. It's like I started in like financial planning after middle ground. It's like, okay, let's just make this better than any financial planning you can find and expand the services. I'm good at that, but like, I'm going to create a new service that no one's ever heard of before. Yeah, you probably won't find me doing that. But so that's a one like breakdown. But across the board, that book just kind of shows the full gamut of like questioning yourself, getting things wrong along the way. It also like covers some of what we talked about, like balance sheet stuff. He shows it really well. Like Nike almost went bankrupt like 1,000 times, right? There's like one point in that book where he's like walking across the street to two different banks trying to like negotiate so they don't like default and like move the debt around. It's like, that was when Nike was already successful. It was already Nike. It was already making money. They just like didn't have any ability to get more money. But when you sold 10,000 shoes, but your vendors haven't paid you yet, but you need to order 100,000 shoes because you have so much demand, like where does the money come from? We borrow it, but at some point that cash cycle can get so crunched. It just shows like leverage really well in debt, actually the bad and good side of what it can do. And then the third part, which I touched on earlier, is like being an entrepreneur is hard. And like even Phil Knight talks about in that book, two things that stick with me. I think about it probably weekly. One, like I said earlier, he didn't actually have any money until he went public. Like he really didn't, like his paycheck, I'm sure he got paid, but like every dollar went back in because again, they were trying to find money to buy more shoes and more product to sell to drive their revenue. And then two, this is obviously, it's kind of his memoir and things like that. This more gets to the philosophical side of like, it shows how much the journey is actually the most fun part. If you decide to be an entrepreneur, it's like, it's going to be so stressful. It's going to be like, you're going to question yourself. Your friends are going to look like you're crazy. But like you look at Phil Knight at the end, like the last thing he says basically is like, had an overwhelming sense of wanting to do it all again. This is after he's worth hundreds of millions of dollars. He tells a story of like running into Warren Buffett at a movie theater, you know, like things that none of us are ever going to experience. And he's like, I just had this overwhelming sense of like, I wish I could just start over from the bottom. So it's not like the arrival that's going to be worth it. I can't answer this yet. Maybe I'll change my mind on it. But reading his story of just like the journey is what like it's all about, which is really cool. And then also just realizing that like no matter how much success, last thing in that book, you're not immune from like the personal stuff. Like Phil Knight tells the story of losing his son in that book to like a diving accident. So just like realizing that this is about all the success really comes back to like personal things and like how it all ties together. So that's kind of my like favorite book for covering the gamut of both technical and personal.
Right. Well, I mean, there's this personal side of the entrepreneurial journey that gets lost.
Yep.
Because what you see is what's been built or how many users or how many products are sold. And you don't, you kind of, when most people would think of Phil Knight, they would see, oh, this guy, he created Nike. This is, look at its omnipresence in athletics or our lives generally now, right? And to see that personal side on the backside is like illuminating in a lot of ways. I love how this ties in though, like just as a happy accident, because I watched, as I think a lot of people probably did, at least parts of the Open Championship, right? Not the British Open, but the Open Championship this weekend. And earlier in the week, Scotty Scheffler, the golfer who won, had said something along the lines of, you know, what's the point of winning, right? Like it's enjoyable. I get a sense of accomplishment and satisfaction from winning, but 2 minutes later, after we walk off the course, it's where are we going to go to dinner? You know, I have a 1-year-old son. Whatever, do I get to spend some time with him tomorrow? And it was this idea, though, that it's not that he was questioning like the purpose of what he does or what any of us do, but if you don't really like the journey itself, if you only want like what the outcome is so fleeting that if you don't love the journey, I think the better question then is what's the point? Right?
100%.
And I think a tough question most entrepreneurs have to wrestle with because of you could just go back to the corporate world
Yeah.
and have a safe, secure paycheck, benefits, get your 3 weeks vacation,
Yep.
right?
Yep.
And just be comfortable. And I don't know, for me, that I can't imagine something more boring. So,
Yeah. No, for sure.
Yeah.
And I think touching on that same kind of spot with entrepreneurship, the thing that most people, again, if anyone listening to this that isn't a business owner, maybe the thing that you take for granted is, I call it self-questioning. And I think it's true no matter what business it is. It's probably hardest in like a services businesses like we have, both you and I, because like what you decide to do for Lockerbie Law tomorrow, you can totally pivot. You're like, well, we're actually going to cut all of these types of relationships. I'm only going to do this type of law going forward. Yeah, you have that flexibility and there's like opportunity there. And that self-questioning, like, would that make sense? Would that not make sense? Is really difficult to kind of queue up around. And same thing in our business, like, oh, I'm only going to work with this type of people, or we're only going to do this type of service. But even if you're, I don't know, selling lawnmower parts to, Toro or whatever, there's still like this philosophical, like self-questioning that can refine you if you let it, or can drive you crazy if you don't. That you don't have to answer. Like it doesn't matter if I'd stayed at Toyota my whole career, even if I was the CEO of Toyota, like you still have a board of directors and you still have so much momentum around the products you do. And one, I never would have been the CEO of Toyota, to be very clear. I'm not that smart. But the answer is there for you, versus actually the smaller the market and the more your flexibility is. And that's not even as true at like a private equity group. Yes, they're still buying and owning and stuff like that, but they're so big that a lot of business are buying at some point, depending on the market you're in, are big enough. They have momentum. You can't just be like, well, we bought a tier 1 automotive and now it's going to be a boat manufacturer. You're like, sure, it has all the parts and that could work, but you're like, you just don't change as fast, versus when you're a nimble service-based company, things can change really quickly. You can add services, and you're the only one to tell you that's a good idea or not. Maybe some partners and stuff around you, but that's hard.
It is hard, no matter what your gut might be telling you or how long you've been in the industry. So what your gut telling you is accurate, or but yeah, I think that is. All right, what's the biggest myth for buyers in this ETA space?
Maybe everything we're just talking about, that it's easier, that it's like easy money. It's like, in some ways, when I compare it to other market segments, the cool thing about technical stuff, if you look at the technical analysis of a lot of these purchases, like the cash on cash return or the IRR, it's like, it's pretty impressive. It's even after you make your debt service and you work with SBA and they have ridiculous costs at closing and all of those things. Even after all that, well, I put, $250,000 in and I can make $400,000 my first year. Like, man, cash on cash is insane. Real estate can't do that. Nothing can perform at that. But realizing that, real estate is like, you have tenants, which matter, but everybody in America needs a place to sleep. Some people choose to buy, some people choose to rent, and those renters are your market, which is a massive number of people in the U.S. When you realize that when you buy a business, the market the market is what you sell to, but the internal market of your investment are actually the 20 employees who sit in that business every day, that all have different goals, who they are, where they want to be, and some of them want, like, write me a paycheck every month. Some of them also want to be the CEO of business, just like you. And you're trying to figure out and navigate all those things. Your risk-adjusted return is not as good as you might think it is. So you have to really like enjoy entrepreneurship and understand that it might look good on paper, but it's much harder than it actually looks like. So that's my like soft answer. I want to give a technical answer as well, which is just financing is more of a headache than you can ever imagine in this space, which I didn't appreciate until I started really working with clients in this space. And that's a myth. SBAs all day. You can see the Instagram videos like, well, you can buy a business and put 10% down and all taken care of. It's like, SBA is not an easy thing to work with. You can get it done, and there's bankers out there that will make it happen. Obviously, SBA does write a lot of loans or support a lot of loans. They're not the ones writing the loan. But make sure you understand the SBA process well before you get into an LI process, because if you don't know the SBA process, then there's a good chance you'll blow up a deal that could have been a good deal because you just didn't prep yourself appropriately.
Yeah. I'm glad you said that, because there's like so many influencers, for lack of a better word, in this ETA space now. And they're posting on LinkedIn every day.
All the time.
I got this business and I didn't put any of my own money down. And it's just like, okay, so the numbers work, but you've never managed a team before.
Yeah.
You've never really dealt with a vendor who wants, to superimpose terms on you and what that means for you. So it's just, it is way harder than what they're saying. There's a huge educational curve to get over. Mm-hmm. But not to dissuade anybody, it's still pretty awesome to be an owner.
So, yeah.
All right, the one myth you think is pervasive amongst sellers in M&A transactions. Main Street transactions.
Main Street transactions. Man, I see it both sides. One is it's almost like it's the value of your business in general. I think I've worked with a lot of sellers who think their business is worth something and it's not. I think just understanding that what your business is worth. I feel like there's only two types of personalities. They think their business is worth 10x EBITDA and it's a sub $1 million business where they're the main seller and like they drive all the revenue and you're like,
they want 10x revenue.
They want 10x revenue. Yeah. I mean, it's like there's some crazy, or you're on the far opposite side and these businesses actually make real money. And the owner's like, yeah, I think it's probably worth $1 million. And you look at it, you're like, I think that's worth like $20 million. It's like, it's one or the other. But I think that is a major myth that your business can't be sold or won't be acquired is a common thing. Also, I don't know if this is a myth, but the belief or like lie that they tell themselves, or the belief that transactions only happen in one way. I think just understanding that actually most of the things we're talking about, yes, we're talking about multiples and all of this, transactions happen in a very different way in this marketplace. The number of times you'll be surprised that it's actually going to go to someone inside the business and it's not going to be like a formal purchase agreement or it will in some capacity, but it's going to be more of like a transition with a seller note and you're going to slowly fade out because one of the employees wants to buy it or your kids want to buy it from you. Or you have a competitor who's just going to kind of consume you and pay you in a different structure. Like the one I talked about before, where it's like it was a residential contractor being consumed by a commercial and kind of teaming up. It wasn't formally like he didn't write him a check for his business. He basically just said, I'll guarantee you W-2 and here's what's going to look like going forward. And their businesses just partnered up. So I think the myth of like, well, you have to sell like a financial buyer, you got to get ready and get big enough to sell to private equity, or you got to go through a broker to sell your business. It's like, you probably know who's going to buy your business if you really think about it. Doesn't mean you don't need a good diligence team, make sure it goes smoothly and all of that. But the myth that you're like going to market, like selling your home with a realtor is probably is a big myth. That's probably not how your business is going to sell, especially at this size.
No, totally. It's a huge disservice to think that there's just one way to get this done.
Yep. And
having advisors around you who can understand and are flexible enough to help you work through the options of what is possible.
Yep.
Yeah, that makes total sense. Well, this has been awesome.
Great.
Thank you so much.
Yeah, thank you all.
Episode 2. We'll have you back, and we're just going to straight up talk business owner headaches.
I love it.
But the joys of dealing with those headaches at the same time.
Anyway. Yeah, so,
for sure. Awesome.
Thank you all.
Yeah, thank you.
Thanks so much.
And if you all liked this video or podcast, hit the like button, subscribe, follow us wherever you listen to podcasts, and check out Logan. We'll link his stuff down below in the description.